on Tuesday. But don't be surprised if I get stumped by some of these problems. Even though I've done them many times, they still throw me off. Okay, so let's start with our review. Standard costs and variances. Okay. All right, so we understand that companies need standards, right? So that you know how to judge your performance. And so you can budget. You have to have an idea of what your costs are going to be so that you can plan a budget. So standards are very important in any organization. And then you can compare your actual performance against the standard to see how did you do, right? Were the costs better or worse? Were the revenues better or worse? Favorable or unfavorable compared to the standard? Okay, this works, and then it didn't work. I don't know what's going on. Okay. We saw what a cost card might look like, where you set out what your standard costs are. Remember that when we're talking about the production of products, you've got material, labor, and overhead, right? And so with each of those, we've got a standard quantity and a standard cost, which could be a rate, could be a price, depends on what we're talking about, right? Like you pay a price for your materials, but you pay a rate for labor. So if you take your standard quantity times your standard price or rate, that gives you your total standard cost for that aspect of your production costs. And then you add them all together and you get a total standard cost per unit of product, right? All right. And okay, so then we got to our formulas, right? And as you noticed, I'm sure on Tuesday, we used this formula quite a bit. This is our direct materials price variance. We use that to see how much the price of our materials differed from the standard price. And we have a second version of the same formula. Sometimes it might be handy to use the simplified version, but they both give you the same answer. Right? And then we saw that we also have a formula for quantity, right? To see, did the quantity of materials, what I'm looking for, vary from the standard? And was it favorable or unfavorable? And again, we have an alternate version of that. And then once you have done both and you have a price variance and a quantity variance, you can just add them together to get your total variance, right? Or you could use this formula to get your total variance, but I usually just add them together. And then we see the relationship here. So if we wanted to calculate the direct materials price variance, where on the screen here do we see our formula for that, for the price variance? Exactly. Actual quantity times actual price, and then you subtract actual quantity times standard price. That gives you your price variance. And then if you want to figure out your quantity variance, it's actual quantity times standard price minus this box, standard quantity times standard price. And that gives you your quantity variance, right? And then you just combine these to get your total variance. So I think the harder part is sometimes knowing what's what. Because the way the information is presented to us, it doesn't always say this is the actual price. Right? Sometimes you have to kind of read between the lines to figure out what's what. But the formulas themselves are pretty straightforward. Another thing that gets tricky is when you have a favorable variance and an unfavorable. Like in this case, they're both unfavorable, right? So we could just add them together to get the total. But if one of these were favorable, Then we've got a positive number and a negative number, and then that can be a little tricky sometimes trying to figure out what the combination is. So, any questions so far? We then got into labor and well, you know, that sounded funny. With labor, it's the same idea, right? It's just instead of a price, it's a rate. And instead of quantity, it's hours. So hours of labor times the actual rate, times the actual, minus the actual hours times the standard rate. So it's basically the same as our price variance for materials. It's our rate variance for labor. And then we also have a quantity variance. Notice here it says the time variance, because that's how we measure the quantity of labor is in time. But it's the same idea, right? Just like the quantity variance for materials. And then we add them together to get our total variance. Okay. Oh, is that's as far as we got. So the next thing on our agenda here is to solve this problem. Let's see. I think this is one of the harder ones, but let's see if we could tackle this together. Well, I'm still somewhat coherent, and then who knows what will happen later. Might not be as sharp. Okay, problem 8. All right. So in the problem set, I've put some of those little tables in there because those are useful in many cases to solve these problems. Let's see what information we have. We've got the actual direct labor hours. So that's the actual hours. We've got the standard hours for that level of production. Okay, so we have the actual hours and we have the standard hours. We've got the total payroll. Now it doesn't specify total payroll for direct labor. Do you think that that's actual or is that a standard? Yes, we can assume here that it's actual. They didn't say budgeted payroll. They didn't say standard payroll. They just said this was the total payroll. So we can assume that's an actual amount. I'll put that here for reference. And then they give us the direct labor time variance. All right. First thing we have to figure out here, what is the actual direct labor rate per hour? Well, we don't have any rate. They didn't tell us the standard rate, and they didn't tell us the actual rate. Actually, we might be able to solve this one even without this box. I think there's an easier way to do it. Who can tell me, how can we figure out the actual direct labor rate? Okay, and which labor hours would it be, Audrey? Exactly. If we take the actual cost of labor divided by the actual hours that were worked, that will give us the actual rate. It makes sense, right? So I should probably get rid of that box in the future, but let's just go ahead and do that calculation. And I'll use a calculator for that. Okay. Okay, so I take the total payroll divided by the actual hours worked. I get a rate of $23.50 per hour. Okay. So let's go with that. Get rid of that table. Okay. But the next question, what is the standard direct labor rate per hour? All right. How do we figure that out? So one thing you can do when there's a missing number, if you find a formula like this one that has what you're looking for, standard rate per hour. Okay, great. That's what we need. If we have the rest of this information, including the rate variance, we can solve that. But I don't think we have the rate variance. We have the time variance. I don't think that formula is going to work for us in this case. Let's look at this formula. We do have the time variance. We do have actual hours worked. And we do have standard hours. We don't have the standard rate per hour, except that appears in the formula twice. So it would be hard to then try to figure out what that is if we have X twice, right? Because X is the missing number. But if we use this simplified version here, we do have time variance. We have actual hours and standard hours that were worked, or actual hours worked and the standard hours as well. So really the only thing we're missing is this one piece of information. I think we can use this formula and find the answer. Does that make sense? Okay. So to get our standard rate per hour, let's take the direct labor time variance. Now, you notice it says that what's in the parentheses here times the standard rate equals direct labor time variance, right? This times that equals that. So then logically, we know if we take this time variance and we divide it by what's in the parentheses, that will give us the standard rate, right? If 2 times 3 equals 6, then 6 divided by 3 equals 2. We're just kind of working backwards. So let's do that. We're going to take our time variance divided by the difference between the actual and standard hours, and that will give us our rate. Okay? The difference between the hours is what? 600. 600. So we're going to take our time variance, divide that by 600, and we get 23. That is our standard rate per hour. Once again, I don't think we needed the table. All right. So we've answered the first two questions. What was the total standard direct labor cost for May? Okay, how would we figure that out? We know the standard direct labor rate per hour because we just figured that out. But what should have been the standard cost for labor for May based on this actual level of production? Yeah, I think total standard direct labor. Well, I'm just trying to think here. Standard direct labor cost, is that based on the standard hours that should have been worked or the actual hours that were worked? What do they mean? Total standard direct labor cost for May. I could interpret that either way, honestly. So let's see, it's either $23 times the standard hours or it's $23 times the actual. You said standard?
Yeah.
You're probably right. Let's check. Problem 8. So 47,400 was the standard. So you're right. Okay. So we're just taking the standard hours times the standard rate, which is 1,090,200. Okay. Now they want to know what was the direct labor rate variance for May. So this is like our materials price variance, right? Whenever you see rate variance for labor, it's like price variance, which means we're doing actual hours times the actual rate minus actual hours times the standard rate. And we have all that information now, right? So actual hours is 48,000. Actual rate is the 2350. And standard rate is the 23. Right? I better check all those just to make sure before we do all the calculation. Yeah, we did get those right. Good. Okay. All right. So then we just multiply here. Actual hours times the actual rate is 1,128,000. Actual hours times the standard rate equals 1,104,000. What's our next step? What do we do here? Okay, we take the left side and we subtract the right side. $24,000 is the difference we got. It is a positive number. So unfavorable, correct. All right, so let's see if we got that right as well. 24,000 unfavorable. All right. Great. It's nice having other minds to help supplement my own mind here. Any questions on this problem? All right. So let's see what's next then, because where were we here? We were there. Okay, so we'll start here on slide 25. Okay, so this slide talks about UPS drivers. I don't know if anybody here has ever been a UPS driver or if we know anybody, but UPS makes its money primarily delivering packages, right? So efficiency is critical. Every extra second on a delivery adds up. So they are very specific. Their drivers are given routes that make it so that they have to make very few left-hand turns. Because you have to wait if you're making a left-hand turn, but if you're making a right turn, you can typically do that even on a red light, right? They're instructed when they step out of their vehicle, which foot should hit the ground first. And they're told how to hold the keys in their hand to make it fastest for them to get the vehicle started. Everything is down to a science so they could be as efficient as possible. But then, sometimes they trying to deliver a package and the customer's, on the phone and isn't coming to the door, or, whatever has to go, their dog ran out of the yard or something like that. And so then they have to balance, okay, efficiency is critical, but I also don't want to be rude to my customer. I don't want to provide poor customer service, right? So then they have to find a balance. Which leads to a question here, which is more important, customer service or efficiency? And that's really something every company has to decide for itself. Which do we care about? Do we care about service, maintaining those relationships with our customers, which will hopefully lead to more business in the future? Or do we want to just quickly get our money and get out of there, right? And there is no right answer. Again, it depends on the company and it's a balance. What we are talking about in this class mostly has to do with things that are very quantifiable. Labor, you count how many hours somebody worked, right? Materials, you can count how much material was used. Overhead, you can figure out your overhead costs. And so really it's all about being efficient. We're not really paying attention to the quality of the product, the employee experience, the customer experience. Those are all important too, right? They're just not measured by these standard costs and variances. But we will in other chapters be talking a little bit more about, those more subjective, qualitative aspects of business. Okay, here we have an example. This company makes shampoo. Standard labor cost, $35 per hour, and it's 1.5 hours per bottle. Okay. All right. Wow, must be some expensive shampoo. And let's see, they manufactured 11,000 bottles. They used 16,000 hours at this cost. We have to figure out what is the labor rate variance, labor time variance, and the total labor variance. All right. So this is definitely a case where those tables would be useful. I think I'm going to open up a Word document here. You can, if you have some paper or oh, I don't want to scramble. What am I doing? Okay. Okay. What am I doing here? Oh yeah, new. That's what I wanted to do. New.
I think she just
you can go ahead and start working on this. See how far you get, but I think you will find it useful if you do use some of these tables like this one. Trying to copy. Because you can use one for the rate variance, one for the time variance, and then you can add the totals together to get your total variance. All right. Go ahead, work together, see if you can find the answers here for this one. Great. So what is the rate variance? Who figured that out? Okay. What is our formula for rate variance? We'll start there. Anybody? Formula for rate variance for labor.
actual hours worked
Okay.
and the rate per hour.
The actual hours times actual rate minus actual hours times standard rate, right? That's our rate variance for labor. Okay, and then we know the time variance starts off with the right part here, down here in the left box, right? Right part of rate variance equals the left part of time variance. And then what's the right part over here? Yep, standard hours times standard rate. Okay, so that's the two formulas, and then for the total, we'll just add the results together. All right. So what is our actual hours? $16,000, correct. Right, it says they used 16,000 hours. They didn't say actual, sometimes they do, but we can assume if that's what they use, those are actual hours. So we will replace actual hours with 16,000. All right. Then actual rate. What is our actual rate for labor? We have to calculate that one. How do we figure out our actual rate? Yep, that's right. So we take the actual labor cost that they gave us, divided by the actual number of hours. And we see 35.35 was the actual labor rate. All right. What is the standard labor rate? 35. Okay. So we have three places to put that. And the last thing we need, what would be the standard hours for that level of production? How do we get that? Yep. They made 11,000 bottles, and the standard is 1.5 hours per bottle. So we take 11,000, the actual production, times the standard hours, 16,500. So like I said, the hardest part is knowing what's what, and then doing the calculations is pretty easy, right? And you can always look up the formulas if you don't remember. Okay, so then we will take actual hours times the actual rate. We get 500, oh yeah, well, obviously, the same thing that was here, right? That was the actual cost, so that makes sense, it's the same. All right, then we have actual hours times the standard rate. 560,000. What do we do next? Subtract, so we get a difference of 5,600, which is positive. So that means our rate variance is 5,600 unfavorable, right? Okay, and then since this part is the same as this, we already know what it comes out to, 560,000. And on the right side, standard hours times the standard rate comes out to 577,500. Then again, we will subtract. And in this case, we got a negative number, right? Negative 17,500. So our time variance is 17,500 favorable, right? And again, the question came up, why is negative favorable? Somebody asked that on Tuesday. Well, because it's less than the standard cost. So that's favorable, right? Higher than the standard cost would be unfavorable. So then we end up with an unfavorable cost and a favorable cost variance. So we could take that negative number and add the positive number. That'd be one way to find the total. So we end up with a total 11,900 That was negative, right? So that is our favorable total variance. So the first one was the rate variance. Second one was the time variance. And then we have the total. Let's look at other ways we could come up with the total. Again, we've got a positive number and a negative number, right? So you could take the positive number and subtract the negative number. You get the same thing. You could take, you could find the difference between the two. And then you just have to think, which one did we have more of? The favorable was larger, so that means our answer is favorable. Whatever makes the most sense for you, you just have to somehow combine the rate variance and the time variance to get a total variance. And if that is confusing, you could also do it the longer way of, where is it? Take the actual hours times the actual rate, subtract the standard hours times the standard rate, and that gives you your total rate variance. Okay, so you have choices. All right, so that was this slide. Anyone have questions on how we got any of those answers there? Okay. All right, well, let's see what's coming up next then. We're familiar with overhead and how we estimate overhead, right? And we take our estimated overhead for the year, we divide it by our estimated activity, right? So this is really nothing new. If you're dealing with standards, it's the same thing. What is our budgeted overhead? What is our budgeted or standard level of activity? That gives us our standard overhead rate. So overhead, variable overhead, has uses the same formulas. Same as we've been using for direct materials and direct labor, we can use those for variable overhead as well and figure out what our variance is. So, okay, this is just sort of a reminder about how flexible budgets work. Actually, I don't know, how much have we talked about flexible budgets? Was that Emma?
Wasn't that in the last chapter?
I think a little bit came up in the last chapter, and I might have mentioned it in this chapter. What's the benefit of a flexible budget?
You can change the amount so that you can actually see.
Yeah.
There's
Okay, you adjust your costs based on your actual sales, right? Because if you just create a budget and you never change it, it's a static budget. And then if your sales come out really different than what you had planned, well then, how do you know if your costs are really in line, right? Because your sales were way different. So in a flexible budget, you adjust your costs based on your actual sales. And then you can compare those adjusted costs with the actual costs and have a better idea of what they should have been. So that's kind of what's going on here. We've got a company that, normally produces at a particular level. That is what they're calling 100%. But they could actually increase their production up to 110% or down to 90%. So what they've done is looked at what's going to be the impact on their variable costs. Obviously, if they need 2,000 hours normally, if they drop down to 90% of that, they only need 1,800 labor hours, right? And if they go up to 110%, they need more hours. Make sense? That would also change the number of units that they're producing. It would also change their variable overhead. But of course, it does not change their fixed overhead. Right? So we could calculate all this. For example, if we knew that the normal production here required 2,000 hours, and they were going to decrease it by 10%. We could just say, okay, what's 10% of 2,000? 200. So notice it goes down by 200 hours. Or if they increase it 10%, it goes up by 200 hours, right? So we could do the math and we could calculate this if we had to, but here it's already presented for us. Okay. Moment. So that's what's going on here. Their variable overhead rate stays the same, but the activity changes. So for example, here at their normal 100% capacity, if there's $4,000 of variable overhead cost, and they're expecting 2,000 hours of labor, that comes out to $2 of overhead per hour of labor, right? Now, if their production goes down to 90%, their variable overhead goes down to 90% of what it would have been, and their labor goes down to 90% of what it would have been. And when you divide, you still get $2 per hour. And if their production increases, overhead and labor both increase by the same percentage. And when you divide, you still get the same variable rate for overhead, right? It's back to that same concept of your variable costs per unit stay the same, regardless of production. But the total variable costs change the more you produce, right? Remember that from one of our earlier chapters? Okay, so when we have to figure out our variance for variable overhead, guess what? Same formulas. Same ones we're used to. Again, slightly different wording. On this case, they're basing their overhead on hours. Some cases, they might base it on something else, but whatever the overhead's based on, that is the quantity. And then there's the rate. Just like with labor, it's not called a price, it's called a rate. Right? In that example we were just looking at, the rate was $2 per labor hour. So you would take your actual labor hours, since that's the activity we're basing the overhead on, times the $2 rate. Well, if that's the actual rate, or if that's the standard rate. But again, same formula, just slightly different words. And so this would be the rate variance for variable overhead. And then, of course, there's another one where we look at the variance in the activity. That's called an efficiency variance, right? So with materials, we called it a quantity variance. With labor, we called it a time variance. With variable overhead, we call it an efficiency variance, but it's all the same thing. Okay, so let's see how it plays out here in real life. Again, this place, let's see. Okay, here they've got 2,000 direct labor hours to produce 1,000 units and 4,000 of overhead, of variable overhead, right? Okay. So we take the $4,000 variable overhead, divide the 2,000 labor hours. That's how we got the rate of $2 of overhead, the variable overhead per hour, right? But let's look at their actual data. Well, they actually used more labor hours to produce the same amount of product for some reason. And their variable overhead came out different. So when we look at the actual data, we take the $7,000 of variable overhead, 2,500 labor hours, and we see that actually the rate that they're paying for their variable overhead is $280. That's a difference of 80 cents compared to the standard, right? And because it's more than the standard, it's unfavorable. And when you multiply it by the actual hours, you get the total cost. An extra $2,000 that they're paying for variable overhead because of both how many labor hours they used and the cost of the overhead. All right, so does that make sense? Taking similar concepts to what we've already spoken about, and we're just applying it to analyze the variance. Okay, as I mentioned, there's also the efficiency variance for your variable overhead. This formula probably will look familiar. Actual hours times the standard rate minus standard hours times the standard rate. Just like we did with material quantity and labor time. Right? We have a simplified version of that formula. So here again, we've got, okay, this time we've got flexible budget over here. Okay, we have actual data here. So let's see what's going on here. We've got the same $2 standard rate, right? But now we're looking at the difference between the actual labor hours, since that's the activity we're using to apply our overhead, and the standard. That was a difference of 500 labor hours. Multiply that by the standard rate, and we see that's costing us $1,000. Because of that extra labor, you know, we're applying more overhead costs than the standard. Oh yeah, and then this is going to be used for the next slide. Okay. So just like we saw with materials and labor, you can put it all in a tree like this. We've got this box minus this box is our rate variance. Middle box versus the right box, that's our efficiency variance. Add those together, we get our total variance. Okay? Any questions? Right. Yeah, I remember. Okay. So this one's interesting. Imagine your company's bidding on this contract to sell planes to the military. Anytime you're bidding on a contract for government work, there's a very specific process. They will send out what's called a solicitation, or sometimes they'll call it a request for proposals. And basically what they're doing is they're inviting companies to bid on whatever work this government entity needs done. So for example, if some military branch says we need 50 to 100 planes, and they contact some companies that make planes and they say, here's a request for proposals. We're inviting you to bid on making these planes for us. And they give you a date, the time that your bid is due. They tell you in great detail what has to be in your bid. And if you want to, you can bid. Now, the nice thing about these government contracts, once you get them, they tend to pay really well. And if you get in there one time and you do a good job, you'll probably be able to keep renewing that contract every time they go out for bid. I used to work for a staffing company that did some work that we had to bid on contracts. There was one time we had worked for months on this proposal, and it was all ready from the headquarters office. They gave it to an administrative assistant and told her to deliver it, you know, to the specific address because it was due on that date at a specific time. She got lost. I think this was probably before people were using GPS, so she was using a map. Anyways, she couldn't find the place until it was too late. She got there, ran in with the proposal, and they're like, sorry, deadline's passed. And we had worked for months on that thing. Yeah, that was I, when I heard about it, I thought it was kind of funny. I felt really bad for her, but it wasn't, you know. I mean, I wanted the company to get the contract, but at the same time, it's like, well, we shouldn't have sent her out there at the last minute to deliver it without better directions. So it's serious stuff when you bid on these government contracts. Now, in this case, again, they want 50 to 100 planes. So we could bid on 50 planes, how much we think it would cost us. We could bid on 100 planes. If we bid on 100 planes, we're going to be spreading our fixed costs across more and more units. So we can charge a smaller price, a lower price, right? When you sell in larger quantities, you can afford to decrease your profit margin because you're selling so many overall, you're going to make a bigger profit anyways. Not to mention that we're, you know, the fact that our fixed costs are spread out further saves us some money. So it would make sense for us to bid on 100 planes, right? Because then we can come in at a lower price per unit than if we bid on 50 planes. But what's the potential problem with that strategy? They only buy 50. Because then we based our costs on 100. And if we only are going to sell 50 and we have to stick to the same cost, we lose profit, right? Because now we're not spreading our fixed costs across 100 planes, it's only across 50. So that's going to reduce our profit and may, you know, depending on the situation, maybe even push us into a situation where we're losing money on the deal. All right, we've done exercise, no. We haven't done 11 yet. Okay, so let's do exercise 11. God bless you. So, number 11. Okay, manufacturer planned to use $78 of variable overhead per unit. So that was the standard, because that's what was planned. It actually used $76 of variable overhead per unit. So that is the actual rate. During the same period, the company planned to produce 500 units, actually produced 540 units. Now, we don't have any information about hours or any other overhead activity. So the only thing we can use for quantity would be the number of units. So now we have to figure out the overhead spending variance. By spending, they're talking about the rate variance. Okay, so let's put in our formula. I'll just call it actual units, since that's what we're working with, times actual rate minus actual units times standard rate. Okay, so our actual units is 540. Our actual rate was the 76, right? It actually says actually. And the standard rate was 78. All right, let me check this one before we go any further. $540, yeah, we did say $540, good, okay. Now we do our calculations. We get 41,040 on the left our actual cost for overhead, for variable overhead. And 540 times 78, that was the standard, so 42,120. We then subtract, right, left side minus the right side. And we get negative 1,080. So our rate variance here is $1,080 favorable. Because we had a lower variable overhead rate per unit, we saved $1,080. Okay. Right, so then what's next? Okay, so why we're doing all this, right? So we can see how much variance we have. In terms of materials, labor, and overhead. But then you want to understand why, right? Because just numbers don't really tell you what you need to do differently to improve. Or if you're getting really good numbers, if you have a really favorable variance, well, great. Now you want to know, what are we doing right? How can we keep this going, right? So, as it says here, managers often have to explain variances that are outside of a certain range. There's always going to be some variance, right? If you're being evaluated on the performance of your department and the variance is unusual, somebody's going to want an explanation. What's going on here, right? So you need to understand what's going on. You need to identify if there are potential problem areas. Maybe you're going over budget, over the standards on certain costs. As I mentioned earlier, if there's a favorable variance, how can we keep it going? How can we sustain that? We also need to figure out, okay, do we need to adjust our standards? Have we gotten so good that now we can set new, better standards for ourselves? Or are we having so many problems with maybe employees that we're hiring or materials that we're using that we need to lower our standards? One of my favorite sayings is that the key to happiness is to lower your standards. I find it works. You know, if you don't expect anything, then you're just fine with whatever you get. Okay, and then it doesn't always work in business, though, right? You can't really tell your boss, oh, it's fine. No, they don't like that. So we need to understand what caused the variance, right? Whether it's good or bad. If it's a bad variance, we want to fix it. If it's a good variance, by understanding it, you can figure out, hey, maybe that's something we can teach to the other employees, or that's something we can implement as a new procedure. Sometimes it's referred to as best practices. If you've got an employee that figures out a great way of doing something, find out what they're doing. And then if that's something you could teach everybody else, great. And everybody benefits. And maybe promote that employee for their brilliance. Again, we do need our standard costs for budgeting purposes and to evaluate performance. Now this slide, I think you'll find really useful. So you can get this in the PowerPoint. I think there's a page in the textbook like this as well. It's got all of these formulas together. So you've got your price variance for materials, on the labor rate variance, the variable overhead rate variance, right? Which again are really all the same formula, just slightly different words. And then you've got your quantity, time, and efficiency variance. Again, same same formula. And then you got your total for each of those as well. All conveniently located in one place. And then you've got the simplified versions also. So we've got direct material price, direct labor rate, variable overhead rate. Got your direct material quantity, labor time, variable overhead efficiency, and then total. And we got 3 of our trees there that we can also refer to. Okay, so as you're working on the problem set, these slides, especially this first one, I think will be super helpful. Anyone have questions? Jordan.
There was a thing that said about like the range of variances that can be explained. Is that something we're gonna calculate in the future?
Was it in the PowerPoint here?
Yeah, it was one of his listing reasons to use variance. Yeah. the first one,
Oh,
where it says outside of a certain range.
oh, okay.
Are we
Yeah,
gonna
yeah, yeah.
calculate something like that?
No, because that's really a case by case thing. It would be up to the company. That's where statistics could come in and say, oh, this variance is within 1 standard deviation or 2 or 3. But then the company might, depending on how accurate they want to be, they might set a limit and say, okay, if we get a variance that's more than this different from the average, that's when we need to look into it.
Yeah, that's what I was thinking of. We got the name, but yeah, standard deviation.
Yeah, luckily we don't get into stats in this class because that was my favorite class, but I'm definitely not, you know, a stats instructor. Okay, let's see. Oh yes, here's another one we can practice with. And yeah, let's do this. So here we need material price and quantity variances. We need labor rate and efficiency variances. And then we're going to do some analysis of those variances. All right. So again, let's see if I can. Oh yeah, let's take a look at the information that's here. Okay, we have standards up at the top. So the standard for materials, they use 4 pounds per unit at a price of $15 per pound. They use 2 hours of labor per unit at a rate of $20 per hour. Then down here, okay, they had no beginning inventory. They completed 10,000 units. They had planned for 12,000 units. Okay, so we have the units that were actually completed and then what they had planned for. Not sure if we're going to need the budgeted output units or not, but we definitely will need the units completed. We've got materials that were used. They actually used 50,000 pounds of materials, and that actually cost them $800,000. So then we could figure out the actual price by dividing, right? Same thing with labor, the actual labor hours and the actual labor cost. So we could divide to get the actual rate. Then we can plug in our formulas to get the variances. All right, so go ahead and take some time to try to figure those out. Feel free to work together on that. I'll show the answers. And then we'll go back to the chapter. Okay, since we only have a couple slides left, I'm just going to stay here in the corner. All right, so here it says that the plant manager has noticed we are using more than normal scrap, meaning we have more indirect material costs than usual. Right, so we either are making products that are not working, we have to throw them out, or we're just using excess material for some reason. And the employees are working more hours than expected. What system might she have used to determine these issues? Well, variance analysis, right? That's what we've been doing. Figure out your costs, your standard costs, figure out your actual costs and how they vary. And then that tells you where there might be some problems. The harder question, why might these variances have occurred? Why might we end up with more scrap material than usual? Emma. Rework. Mhm. Okay, so it definitely could be that the material is inferior, that's causing more wasted material, and the employees have to spend more time fixing it. That could be. There could be other factors. What other thoughts do you have?
Also, she's saying the employees they're making more mistakes.
The workers might be making more mistakes. That could lead to scrap. And then again, takes them more time to fix their mistakes or start over with new units. Maybe our machinery is having some trouble. Maybe it could be something like, temperature issues. Okay. Yeah, exactly. Maybe we lost some of our more experienced employees. So all of those different factors could be the cause. And it would take a little bit of investigation, right, within the organization to figure out what exactly was going on. All right, so let's summarize this chapter. So standards are both for price or rate and for quantity, right? And that applies whether we're talking about materials, labor, or variable overhead. And then once you have standards, you can compare your actual performance and see how much variation you have. Favorable means your costs are less than the standard. Unfavorable means your costs are higher than the standard. For overhead, there is variable and fixed overhead. Mostly in this chapter, we're focusing on the variance of the variable overhead because flexible overhead is less variable, right? It's more, did I say flexible overhead? Fixed overhead, there's no such thing as flexible overhead. Fixed overhead is less variable, right? So it's not as big of a deal. We will see an example of some variance related to fixed overhead, but it's more the variable overhead that is variable. All right, and then when it comes to variable overhead, we have a rate for overhead and then some activity that we're using to apply the overhead. So sometimes it's labor hours, but it could be other activities as well. Again, the whole point is to not only understand what the variance is quantitatively, but to understand why. Why are we having these variances, right? Because only then can you benefit from that knowledge, right? Because you could either fix it if it's a problem or continue it if it's something good. And the final point is that all companies, not only manufacturing companies, can use variance analysis. So even if you're a retailer or a service company, you can still use these same techniques, right? You just wouldn't be necessarily using it for material costs, but you would still have labor costs, you still have overhead costs. So that's going to apply in any company. All right, and it's a minute before break time. Are there any questions?